So our next question comes from Heather M. Heather says, my husband recently took a job that doesn't offer a 401k until he's been with the company for a year. As soon as he starts his 401k, though, he will be completely vested. So in the meantime, what should we do to make up for the lost year of contributions? He's 62 and I'm 57. He was also unemployed last year, but doing some side hustles, so it might actually be 2 years of lost contributions by the time his year is up. We talked with a financial advisor and he said that we're doing great with our retirement accounts and he would be fine if he had retired now, but he plans to work until he's 65. We also own real estate and have rental income. We have no credit card debt. The only debt we have is a HELOC at $33,000 and a $100,000 mortgage on a rental with 15 years left. We have an emergency fund of $26,000 in my account and $16,000 in his account. We're also fully funding our Roth IRAs, and yes, the money is invested. So I'm curious about the different avenues to invest what would normally be going into a 401k. I think I want to set him up with an automated investment plan on Public, but I've also heard of solo 401ks, double finance, FREC, M1 Finance, and I've been using Schwab for investing for a while now myself. Can you maybe explain some of these programs and help me figure out what would be a good option? Heather, I love that you're being so proactive about this. Let me also be very clear. Your husband not contributing to any retirement accounts or any investment accounts for the next 12 months will not inhibit your ability to retire, right? So like you could do nothing for the next 12 months and still retire, according to your financial advisor, just fine. Because if you can retire right now, you can retire in 12 months, you can retire in 24 months, like you're going to be just fine. So I just want to like give you a sense of relief, take a deep breath, like everything's going to be cool. So you wanted a breakdown of some of these different types of accounts. I'd be happy to give it to you. A solo 401k is for a self-employed individual. You said that he was unemployed, which is different than self-employed. So I'm going to assume that a solo 401k is not a part of the equation here. However, I have a solo 401k. Robert has a solo 401k. We're self-employed guys. Therefore, we take advantage of this retirement account because we don't work for a company that affords a 401k to us. We have to go contribute and make one our own. So that's a solo 401k. So now let's move on to double finance. JJ Maxwell is the founder and CEO of that company. We actually had him on the show a couple months ago, I want to say. It was a great conversation if you've not yet listened to that episode. He's essentially built a platform that allows people to build their own S&P 500. So if they want to be a little bit more overweight on technology because of AI, or maybe a little bit underweight on energy because they don't know what's going on with OPEC, right? You can build your own strategies around your portfolio. It's more of portfolio investing versus like stock investing, if that makes sense. They've got a bunch of different strategies pre-built that you can select from. It's just like a normal online broker, but they give you the strategies versus you building them from scratch. The next platform you mentioned was FREC. FREC is great because they do tax loss harvesting for you automatically. Robert and I have an account with FREC. We put, I think it was $20,000 in the S&P 500. We've tax loss harvested thousands of dollars so far in that account completely automatically, and their fees are super, super cheap. Really enjoy FREC. That's probably the one I would recommend you check out if you're really trying to find some extra momentum during this period of time. M1 Finance is just another online broker like Public or Robinhood or Schwab that you had mentioned. Nothing too special about it. Long story short here, 2 or 3 big takeaways. The first one is you're going to be just fine regardless. If you're investing, if you're not investing, if your financial advisor tells you you could retire right now, chances are you've got hundreds of thousands, if not millions, in these retirement accounts already, and you're going to be fine. The second thing is if you're looking for maybe something to do during this next 12 months, doing it inside of an account and building an investment plan around it, like you had mentioned with Public, is a wonderful idea. And what's important about all this is automating the process. So similar to how you might have been contributing every paycheck to a 401k, if you build out an investment plan on Public every other week or once a month, you can contribute to their brokerage account and invest that money similar to how you would have automatically with a 401k. I think that's the most important takeaway here.
Yeah, and I want to piggyback on that. I think so many people that are going through transitions where they may not be with a company with a 401k or they're switching jobs, they have that vesting period. The most important part to remember is just because you don't currently have this eligibility to invest in a 401k, it doesn't mean you should stop investing. You should just right away pick up the pieces and say, all right, the new job starts in a month. Then in 13 months, I'll be able to add to the 401k there and be invested. And I just think it's important to understand, invest and put that same amount of money you'd be putting in the 401k into that public.com account, because then you're keeping the train moving, you're building your net worth, and just don't take those long breaks just because you switch jobs or you pivot away from a position, because at the end of the day, the more consistent you are with your investing, the better off you're going to be long term.